Hi, I'm Linda Eads. Welcome to our webinar, What's in the Mix for 2026. Today's discussion is all about some of the central themes we think will be driving investment outcomes next year and beyond. To do this, I'm here today with four of our portfolio managers. Joining me here in Cape Town, I have Nick Balkan at the end, our Chief Investment Officer, and Rashad Taib. And further afield, we have JC Shui and Ishrath Hassan joining us from our Singapore office. But before we get into the forward-looking content, I'm going to give you a quick update on how asset classes have performed over the year to date, just to set the scene. And then Rashad is going to follow with a discussion on some of this year's hot topics. Of course, that's the dollar, that's the gold price, where we see opportunities in the fixed income space. And after that, we're going to shift gears to global equity. We're going to take a look at opportunities through two lenses. Firstly, JC is going to do that through a geographic lens, and then secondly, Ishrath is going to look at it through a sectoral lens. After that, Nick will focus more on South African opportunities and in particular on South African equities. And I'll be posing a few questions to the portfolio managers along the way. So, during the course of the presentation, I am going to do a poll to get a gauge of what you're thinking going into 2026. So please stay engaged and participate in that along the way. So let's start with an update on asset class returns for 2025 thus far. On this chart, we're showing the returns for the various global in dark blue and local asset classes in orange for the year so far. So this is going to 31st of October 2025. And the first thing to note is that it's been an unusually strong year across almost all major asset classes, globally and locally. So it's been a very good year for most investment portfolios. And I'm happy to report that Foord portfolios have also participated meaningfully in these upbeat markets. So looking at world equities, we can see they generated just over 20%, supported by still resilient earnings and steady global growth. US equities delivered a very solid 16%, which is quite surprising given where they've come from over the last few years. Not quite as high as previous years, but still a very solid return over and above inflation. But the real standout this year was the Chinese equity market, which delivered over 30% in US dollars. Now, outside of equities on the global side, we saw slightly more pedestrian gains from global bonds, but in positive territory nonetheless, and property did pretty well as well, supported by falling interest rates. Now, the exceptional performer, of course, was gold. It was up 52% to the end of October in US dollars this year. Oil prices moving in the opposite direction, down 12%, which of course has helped contain inflation everywhere around the world, including here in South Africa. And another big driver for South African returns has been the weakening of the dollar. Now, the dollar is down 9% relative to the rand, but it's down 10% relative to euros. And I think this is important to note because we certainly do tend to, I think, as South African investors, measure our global returns in US dollars. But if you actually took some of those global asset classes and you converted them to euros, you'd actually see that some of those numbers would actually be in negative territory. So that's something to think about and something Rashad is going to actually touch on. So the gold price going up, the oil price going down, and the dollar going down have all been very strong tailwinds for South African assets. The equity market here has been up 33% in rands this year, even more in dollars, of course, but we must caveat that with the fact that it hasn't been broadly driven. The majority of that has come from gold and platinum producers, but certainly local bonds and property have also fared very well with the backdrop of improving sentiment and, of course, falling interest rates. Now, as I mentioned, Foord funds have participated meaningfully in these absolute returns the market has afforded us this year. But of course, there's always that balance of weighing up those opportunities to get those returns with the risks along the way that may actually put that capital at risk. So that's what we're going to be talking about. Where to from here? How do we position portfolios for this environment? Are we seeing more opportunity or more risk? And how do we strike the right balance between the two? So to begin, Rashad is going to take us through the key global drivers I touched on, the dollar, gold, bond yields, and outline our thinking on the macroeconomic front and how it informs our fixed income positioning.
Thanks, Linda. I'm going to start off with the dollar. As Linda mentioned, we've seen a very broad-based asset rally in 2025. And one of the key drivers for this has been the decline of the dollar. If you look at the chart here, I've got the Bloomberg Dollar Spot Index, and you can see that has fallen around 10% from its peak. And that was due to the America First Trump tariff policies that came through in April, but actually caused a significant decline in the dollar. That happened primarily in the first half of the year. Since then, we've seen an unwind of some of those tariff policies. We've seen trade deals getting done. We've seen Trump doing a lot of backtracking. In fact, even yesterday, Trump removed tariffs on some food items, tea and coffee, oranges, which is important as a South African export to the US, beef. And I think what he's seeing is the pressure on the US consumer, the cost of living, and he's been forced to basically say, take those tariffs away, and because it is having a direct economic impact. The dollar, if you look at the last 10 years, it's back to its average, and we think that the risks are more balanced. At the moment, people are very negative on the dollar. They're expecting a leg down, but we do think that in 2026, it'll be difficult for the dollar to decline to provide the same boost to asset markets that it did this year. Another beneficiary of the declining dollar has been emerging market bonds. When the dollar falls, you see a rush of assets out of the United States, and one of the beneficiaries, not only emerging market equities, is also emerging market bonds. What I've got here is the spread between emerging market bond yields and US yields, and you can see that that is around 200 basis points, 2 percentage points, and it's close to its 20-year lows. So it's not only the Mag 7, it's not only equities that have been the beneficiary of a weak dollar environment, it's also emerging market bonds, and we've seen very strong flows into emerging markets, including South Africa. We've seen one of the big beneficiaries of a weak dollar is obviously the gold price. What I've got here on the top is the price of gold, which is hovering around the $4,000 level. On the bottom is the US 20-year real yield. And what's interesting about this recent gold rally, it's that it's happened despite the fact that US real yields are at a high level. Now, gold historically has generally performed in easy monetary environments when the Fed is cutting rates, when you're having lots of QE, and that's exactly what we saw in the 2018 rally. In 2018, the gold price moved from $1,200 to above $1,500, and that coincided with the Fed beginning a rate cutting cycle and the Fed launching QE again. So that rally in gold was, I think, quite anticipated by the market. What we've seen recently is that real yields in the US have been high and have been consistently elevated. These are levels we've last seen during the financial crisis, but despite that, gold has had a very strong rally, best performing asset class in 2024, and is set to be the best performing asset class again this year. And the key to that is that central banks have been the biggest buyer of gold, especially the rally when you saw from $2,000 to $3,000. It was an era of central bank accumulation in an environment where the US had aggressively, was following quite an aggressive policy in terms of controlling the dollar. The confiscation of Russian reserves was a trigger point, and you've seen central banks look to diversify their reserves into a neutral asset, and gold has been the primary beneficiary given its 2,000-year history of being money. So over the last 6 months, we've seen investors begin to participate in the rally. So they missed out from 2,000 to 3,000, but in the last 6 months, you've seen ETFs accumulate a lot of gold, and that's not quite as much as the 2,000 rally, but investors are definitely participating, and it's pushing gold to what we think are quite elevated levels. And that's reflected in the gold price to oil ratio, which Linda mentioned, and you can see how high that is relative to history. Gold is definitely outpacing the broader commodity complex because of its unique position as a currency. And South Africa has been a direct beneficiary from this. We export gold and we import oil, so from a terms of trade perspective, this ratio moving up is the best case for us. Now, when we look at gold, we view it as a currency, and it's a currency where supply growth is very limited. So it's all about the demand dynamic and trying to understand the scenarios around where the demand levels are going to be for gold going forward. I'll focus on scenario 2, where we're primarily seeing gold in a range of $3,500 to $5,500 due to the fact that there is a structural increase in demand for gold as a neutral asset in an environment of a weaponized US dollar, in an environment of trade conflicts, in an environment where there's a conflict going on between the US and China, the US and Russia, etc. So the structural demand levels for gold is high. What is being priced in at the moment is a lot of Fed easing next year. And I think what the market is seeing is once Jay Powell ends his term as Fed governor, Trump is looking to replace him with someone who's going to be very dovish and very willing to cut rates aggressively into next year. I think a lot of the gold rally in the last few months has been around expectations for ultra easy monetary policy. Now, there are other scenarios. If we look at scenario 1, if that ultra easy policy doesn't materialize, gold could experience somewhat of a pullback. In a scenario where the world learns to get along, geopolitical conflict subsides, maybe gold can go back substantially down to around the 2,500 level. But there's also a tail risk scenario, given the debt outstanding, the inability of governments to balance their budgets, a tail risk scenario where central banks give up on their inflation mandate, gold could definitely go much higher. So I'll end off the global section just talking about interest rates, and here we're using the Fed as the benchmark for where the global rates could be. The Fed funds rate is currently at 4%, and the market is pricing in Fed funds rate around a further 75 basis points worth of cuts to get to around 3.25%, which seems fair in an environment where inflation is quite sticky and close to that 3% level. We're not seeing inflation head back to that 2% Fed target range anymore, which means that the Fed has to keep rates a little bit positive in terms of a real yield. We see a range of 2.5% to 4.5%, and if we do see and the only reason it could get lower is if we see a big risk-off event, like an economic crisis or recession, where the Fed is forced to cut rates a lot more aggressively. So coming to South Africa, we've found ourselves in quite a sweet spot in 2025. We've had Trump policies devaluing the dollar, causing nice flows into emerging market assets. We've had the GNU remain intact as a first case, but also begin to work together a bit better. And that was evidenced in the recent budget. We've seen the gold price rally, and we've seen inflation in South Africa being quite muted, and the SARB has taken advantage of that by reducing the inflation target from the old 3 to 6% band down to a 3% band with a 1% tolerance. So all around, a lot of positive factors there have been a lot of positive factors in South Africa. And the bond market has benefited from this to a large extent. We've seen over a 300 basis point rally in the bond yields. And this graph shows the gap between US bonds and the gap between South African bonds and US bonds. And you can see that's the narrowest gap that we've seen in the last decade. It's close to where we were in 2013. But you must remember that was an environment of ultra-low policy, lots of quantitative easing, and also South Africa with a debt-to-GDP ratio of 45% as opposed to the current level, which is close to 80%. So our financial position is a lot worse than it was back then. So a lot of good news is already being priced into SA bonds. That being said, there are some challenges going forward. The first challenge we see is implementing this new inflation target. What I've got here is the 5-year break-even inflation rate, and that's currently at 3.5%. Now, what that means is that the nominal bonds are pricing in inflation very close to the SARB's new target. Historically, you can see on a 20-year horizon, historically, bonds have priced in inflation of around 5 to 6%. So the market has already discounted and priced in a very positive inflation outcome, despite the challenges that will come in the forthcoming years into achieving that target. The first thing is, inflation has been structurally higher than 3%. So we've got a new range of 3 plus minus 1%, which means that our new range is 2 to 4%. But the South African inflation we've experienced has hardly ever been below that 3% level. We've spent the majority of the time well above 3%. So it's not necessarily a symmetrical target. We've got administered prices, we've got which have increased in the double digits. We've got wage increases. Even in recent months, we've seen wage increases settling at 6, 7, and 8%. We've got a high debt level, which means that if you reduce your inflation, your nominal GDP growth is low, and your debt to GDP is at risk of going up. We also have a very long-term expensive debt where we've raised long-term bonds with a weighted average maturity of around 10 years, and we've borrowed at 11, 12, and even up to 13%. And if you then reduce your inflation target, it makes those debt levels even more costly. And I think the final risk is the inflation sweet spot we've experienced over the course of this year may not last. So inflation is cyclically moving upwards towards the high threes, maybe even around 4%. And there's a chance in the first quarter of next year where if maybe the oil price shifts up, we'll see inflation printing 4.1, 4.2%. Now, under the old target, that wouldn't be a problem. It would be business as usual for the SARB. But what do they do now that if we above the upper end of the inflation target and growth is still constrained? I think they will be in a very tricky position. The second challenge we have is to stabilize the government debt. The chart on the right shows that debt at the moment has just gone over the 6 trillion level, and you can see over the next 3 years, we're still adding 300 to 400 billion a year of debt. So we're likely to, even according to Treasury's estimates, we're going to end up with 7 trillion of debt over the next 2.5 years. The left chart shows the debt to GDP ratio that the SARB has projected in last week's medium-term budget, and you can see that's just close to that 80% level. And what the finance minister mentioned in the budget speech is that every year since 2008, the debt to GDP has gone up every single year. Now, the market's gotten quite excited because the minister has said that this is the last year that it will go up, and for 2027 will be the first year in 15 years that the debt to GDP will actually come down. Now, I think it's a little bit premature to call that. We'll have to see what develops over the next year and whether we actually achieve that reduction in the debt to GDP ratio. The third challenge we see is maintaining the ANC-DA coalition in the form of the GNU. That's been rocky at times. The ANC has tried to steamroll over the other parties and push through bills. And we saw earlier this year, the February budget had to be redone twice, and it was only on the third attempt that the budget was passed. This budget, the medium term, I think we saw a lot more positive working relationship with the other parties, and it is evidence that maybe that the GNU is working a little better. However, there are many within the ANC who view the GNU as a purely tactical position until the next election, and they don't necessarily like the fact that they have to account and the DA is constantly watching over them. So it will be a challenge going forward that the politics remain stable and the GNU continues to work. So summarizing the macro outlook for 2026, we saw a rate cutting cycle in 2025. That's likely to continue with the Fed cutting rates a few more times, but maybe not necessarily that aggressively given inflation is sticky. The dollar decline has fueled global asset returns in 2025, but it should find some stability unless we enter a US recession. Debt and deficits are a continued challenge. I think this will be the shadow hanging over the global economy because most countries in the world have still lost the ability to control their spending post-COVID. A lot of them are still at record high debt to GDP ratios. We saw the debt position of South Africa in the budget last week. The US is still running a deficit of close to $2 trillion, even while the economy is growing. We've got the UK budget next week, which they're struggling to balance. The politicians promise no more taxes, but they're having to go back on those promises because they can't find the money to cover their spending. So we do think that the global debt situation remains a tail risk for the global economy. Overall, a lot of good news is being priced into the rand and South African bonds. We've seen a strong rally in both those assets. And at this point, we definitely prefer inflation-linked bonds where we're getting very good real yields and SA-focused equities, which haven't necessarily caught up with the recovery trade we've seen. Thanks, Linda.
Thanks, Rashad. Nick, I want to bring you in here. Rashad was talking about the dollar, but what does that imply for the rand? Because we've obviously had a strong year. How are you thinking about the rand right now, particularly in the context of allocating between offshore and local assets?
Yeah, listen, the rand's a bit of a moving target. I think the recent move of the rand down to 17 has been a really big move. You alluded to it at the very beginning of the presentation that probably half of that rand strength is actually dollar weakness. So you've got to see it in the context. The rand against the euro has not performed as well. So I'd say that half of the rand strength to 17 is dollar weakness. The other half is commodity prices that have done very well. Remember, we might not be the biggest gold exporter in the world, but we still are recognized globally as a gold exporter. So when some American sees the gold price going up, they do kind of associate it with South Africa. So emerging markets have done well, like Rashad said. So there's a combination of all of those things. That means that the rand, in our minds, using unit labor cost is not too far from reality. We think maybe 1750, there and thereabouts, given the commodity prices. But the problem is the weak underbelly, which is the manufacturing sector. To me, that is the bigger risk longer term. So when things normalize in the commodity prices, we're going to need to sell more vehicles and more other non-commoditized manufacturing items to keep the trade balance up. So I would say for now, given all the things that Rashad said and your intro, the rand feels about right around 1750, but I do think that the bias should be to see it weakening over time. And in that context, the opportunity set globally is still very good. We'll talk about it a bit later, but I do think that in that context, the rand shouldn't be a hindrance to be investing offshore and having a big portion of your portfolios offshore still.
Rashad, I want to talk a little bit about private credit because it's been a big buzzword, private assets, private credit, and you spoke about how spreads have narrowed, generally speaking, and there's a famous quote by an economist, Friedrich Hayek, who said, "The worst of loans are made in the best of times." We've seen a few cockroaches creeping out of the private credit system recently. There's been a few high-profile bankruptcies coming out of the US. What are your thoughts on private credit, and are there more cockroaches lurking in the drains, do you think?
Yeah, there's been lots of once-offs. So I think that the halo around private credit is beginning to dissipate. So we've seen a lot of money flowing into the asset class. It's seen as this unique ability to provide a very good yield because global spreads are low, credit spreads are low. So how can I get a good yield but without taking the risk? But there's no such thing as no risk without return. And I think the events that we've seen just in the last 2 months are really, should really open people's eyes to some of the risks out there. You've had a $5 billion plus default in First Brands where the private credits are doing loans extended to a very low quality company with a single B rating against somewhat secured type of debt, against invoices. But unfortunately, what people saw is that no one's actually checking whether those invoices actually exist and whether they only pledged to a single company. So what they did is they falsified invoices and they pledged them to many different private credit vehicles. So when the private credit blew up, there was no real assets to back that. The one more shocking one which happened last week was Renovo, and there we saw BlackRock, a private credit firm, extended about $120 million to a company which has and at the end of September they had marked that loan at 100. Even though early in the year there were debt-to-equity swaps, they had already stopped paying interest, yet at the end of September that loan was marked at 100. At the end of October it was marked at 0. So that is, you won't see that in the public markets because sunlight's the best disinfectant. There's a lot of people watching it. But if it's tucked away in a private credit portfolio, people really don't have visibility of what the price of the assets are marked at in the portfolios.
And the other risk with that, just to add a little bit to it, is that more than 50% of credit, at least on the corporate side, is being initiated by these private credit organizations as the banks shift all of that credit to these entities. But the problem is they don't really hold capital. It's a really long story, probably not for this moment, but BlackRock would not hold any capital against that loan. So the investor in that fund would suffer the full loss of the write-down. But I do think there's an element of bringing those private credit companies back into the mix and actually making them almost seen to be bank-like, given what they're doing.
Okay, let's shift gears a bit and talk more about our global equity positioning. On the global side, firstly, I'm going to hand over to JC Shui, one of our portfolio managers in Singapore. He's going to talk to the right geographical mix in portfolios going into 2026. So we're going to consider opportunities and risks from a geographical perspective first. Over to you, JC.
Hi, everyone. Today, I'll first spend some time running through our positioning and outlook from a geographic standpoint before sharing one investment idea well positioned for 2026. I'll start with the Global Equity Fund's regional breakdown. As it stands, we retain balanced exposure to different regions. On the chart, you can see that we have roughly a third of our exposure in Asia, a third in Europe, and a third in US for the Global Equity Fund. And the Foord International Fund also has similar exposure. This exposure continues to be quite different from the MSCI World Benchmark Weights, which has 2/3 exposure to the US and around 15% each to Asia and Europe. The next slide highlights why we retain such a different exposure to the World Index. As you can see, the chart on the left shows the MSCI US forward P ratio. At 26 times PE, the US market is trading at a 2 standard deviation above its last 20-year average valuation. And that's very elevated versus history. So if we dive into the composition of the index, the risk becomes even more apparent. The Magnificent Seven, including Nvidia, Tesla, and Apples of the world, makes up about a third of the index, with a market cap weighted forward PE ratio of 55 times. And the next 20 largest market cap companies trade at a market cap forward PE ratio of 57 times. So, the exuberant valuation are not just in the AI tech companies of the world, where Nvidia trades at 40 times PE and Tesla trades at 300 times PE. But we are also seeing high valuations across darlings of every sector. For example, Eli Lilly in healthcare is trading at 37 times PE. General Electric in industrials is at 45 times. And even the staples of the world like Walmart and Costco are trading at 39 times and 46 times respectively. These large retailers didn't suddenly find new growth engines, but the valuation multiples have simply expanded. We have seen this before during the dot-com bubble. People recount the extreme valuation of tech companies during dot-com, but many have forgotten that it was more than tech that was expensive during dot-com. Coca-Cola, was trading at 40 times PE in 1999. GE was 39 times PE, and Walmart at 46 times, and even the likes of Johnson & Johnson's traded at 41 times price to earnings. So history doesn't repeat, but the resemblance today is uncanny. In short, valuation in US looks stretched. On a relative basis, China and Europe just look a lot more reasonable, trading at 15 and 16 times PE respectively. And so as a result, we've just found a lot more attractive investments in China and Europe relative to the US. We have shared our thesis behind many Chinese companies we owned previously, from Alibaba to Tencent and JD.com. Some of those theses have started playing out, and we remain happy holders as the markets start recognizing the value we saw. Outside of the Chinese holdings, it's worth highlighting mispriced value we also found in Europe. And Fevertree would be a good example that I'll dive into next. So Fevertree is a business we like and is positioned well for 2026. In short, it's the world's leading premium mixer beverage company, founded in London some 20 plus years ago. Think tonic water and ginger beer. On the slide, you can see the poster on the left Fever-Tree sold the idea of having premium ingredients in the mixer. If 3/4 of your drink is the mixer, mix with the best. That's the tagline. And before Fever-Tree came about, mixers were largely cheap syrup with little focus on quality ingredients. Fever-Tree has since become the category definer, having built their premium brand over 20 years. They have just under 50% value share in the UK mixer market, but remain in early innings of international growth. Most notably, they recently announced a strategic partnership with Molson Coors, a leading beer company in the US. Specifically, Molson Coors will upgrade Fever-Tree's production and distribution capabilities in the US, allowing the company to become an asset-light royalty stream earner, much like how Coca-Cola makes money selling its syrup. Fever-Tree spent 2025 transitioning into Molson Coors' much larger distribution network and will launch its first nationwide marketing campaign in 2026. The company grew without huge marketing spend in the US to become the leading premium mixer brand with 5 times the market share of the number 2 player. Its first nationwide marketing campaign, combined with the distribution muscle from Molson Coors, will definitely elevate its growth profile substantially in the US. This likely growth acceleration in the world's largest consumer market is being underestimated currently. Its potential to then replicate similar arrangements across other geography means its long-term growth and mature stage margin profile is also being undervalued. Currently, Fever-Tree is trading at around 16 times normalized free cash flow multiples, which we think to be attractive, especially as the story becomes clearer as the company executes its new partnership throughout 2026 and beyond.
Thanks, JC. Another way of looking at global opportunities is through the lens of what sectors to invest in. So I'm now going to hand over to Ishrath Hassan, another one of our portfolio managers in Singapore, who's going to walk us through our views on a sectoral basis, starting with a sector we're not so keen on for the moment. Over to you, Ishrath.
Thank you, Linda. So for most of the past 2 decades, all one needed to do in order to outperform was to own the indomitable technology sector. IT outperformed the market by more than 500 basis points a year over the past 20 years and a stunning 800 basis points a year over the past 10 years. However, given what's happening around the AI infrastructure build-out and market sentiment today, the technology trade is highly unlikely to work in the same way going forward, which is why we have a substantial underweight to the sector. First, let's consider the starting point. After almost 2 decades of outperformance, the IT sector is now the most expensive it's ever been at around 30 times earnings. The sector constitutes almost half of the S&P 500 today versus less than 20% in 2013. It's also extremely top-heavy, with the Magnificent Seven making up more than 2/3 of the sector. So today, the market and technology is driven by an incredibly narrow, very expensive subset of businesses. Given their valuations, everyone seems to be making a one-way bet that this AI mania will enable these businesses to continue to outgrow and outperform as they have over the past decade, while ignoring some alarming fundamental issues, which I'll go into shortly. In our view, the momentum in these stocks and companies tied to the AI infrastructure build-out could easily reverse in the next year or two. Most of today's AI capex with companies like Google, Meta, ByteDance, or even Amazon is being funded by revenue and cash flow generated through advertising. Digital advertising now accounts for more than 70% of all advertising, so the penetration-driven growth story of the past is almost over. Going forward, digital ad growth should now trend towards overall ad growth and not faster as it has in the past. Over the past 100 years, advertising revenue as a percentage of GDP has always remained constant at around 2% of GDP, no matter what. And it's unlikely that AI is going to change that in any meaningful way. The world only has a finite population with finite needs and only 24 hours in the day or so to view content and media. So ad budgets will have this natural ceiling always. At the same time, competition has increased dramatically. In the last decade, Amazon dominated e-commerce, Google monopolized search, Microsoft dominated software, and so on. Their only competition came from slow-moving legacy incumbents. But this is no longer the case today. Instead of playing in their different sandboxes, everyone has converged on the same AI arms race, where they're now all effectively competing directly against each other. Some may say that the upside could come from AI cloud computing, which has been another major source of growth over the past decade. But the cloud market structure is also shifting with AI. Cloud used to be a three-player oligopoly between Amazon, Microsoft, and Google, which led to very high structural margins. But with the massive AI data center build-out and exuberantly careless liquidity now flowing into the sector, you have many new players like Oracle, CoViv, CoScientific, and sovereign cloud providers in the Middle East, all vying for market share by undercutting the leaders on pricing and losing a lot of money while doing it. Still, this hasn't stopped the valuations of these so-called disruptors from reaching ridiculous levels. It's also unclear how much of the stronger cloud providers like Microsoft and Google's revenue growth now comes from AI startups like OpenAI and Anthropic, which are funded by the same cloud companies in circular deals that have become a norm in the recent past. If and when this funding dries up, so too will cloud growth. These circular deals are very similar to what happened during the internet bubble in the 90s. Telecom companies like Lucent and Nortel lent money to the internet companies to buy their equipment, with most of these buyers going bust, leaving the telecom providers nursing heavy losses for years to come. And all we need to do is look at the revenue generated from AI pure players like OpenAI, Anthropic, xAI, or Mistral, and their collective revenue is just around $20 billion today, while incurring massive losses to generate this revenue. And this pales in comparison to the $500 billion or so in capex being spent to generate this revenue. And this capex is only expected to grow from here on out, in some cases expected to double by 2030. So in the past, many of the Magnificent Seven were able to grow rapidly without requiring much incremental investment, which allowed them to generate exceptional returns on invested capital that support their current valuations. But this no longer holds true in today's AI era, at least for the next 3 to 5 years. Big tech capex as a percentage of EBITDA is now running at around 50 to 70%, which is similar to AT&T's 72% at the very peak of the 2000 bubble, and ExxonMobil's 65% at the peak of the 2014 energy bubble. Historically, companies and sectors with higher capital intensity tend to be structurally poor investments. So AI capex has already caught up to prior bubble levels, even after adjusting for big tech's high starting margins. In both the telecom and internet bubbles, the exciting new technology like the internet or shale gas justified the unprecedented investment levels. Eventually, though, supply outstripped demand, and the companies earned very weak returns on their investment. However, consumers benefited massively from cheap internet and cheap oil. One also needs to keep in mind that AI capex amounts to more than 1% of US GDP, which is more than half of this year's GDP growth of America. So the ripple effect from this unwinding can also be quite substantial. At the same time, we're finding lots of value across sectors that have been broadly ignored as they don't have an AI halo or perceived as AI losers. healthcare and staples, for example, trade at almost half the price of technology when you exclude certain outliers like Eli Lilly, Walmart, and Costco. We're finding many idiosyncratic opportunities in these sectors like Fevertree, the Fielman Group, and Roche, for example. Now at Foord, we don't make 0-1 bets, so we'll always have some exposure to idiosyncratic structural winners like TSMC and Google, which JC touched on, but we remain quite comfortable with our underweight to the IT sector as a whole.
Thanks, JC. Thanks, Ishrath. I want to move back to you, JC. I think given Ishrath's argument that he's laid out about US big tech, investors might be very interested to see that Google or Alphabet is one of the top holdings in the Foord Global Equity Fund. So, JC, can you outline why we think that Google is likely to be the outlier with regards to big tech, and why we're still comfortable holding it at current levels?
Sure. I think while we see parts of AI becoming frothy, we are still trying to find mispriced value that will be winners of AI over the long run. So Google is where we see continued mispricing, even though it has rallied quite a bit over the recent months. Right? Google is still the only company in the world with 7 applications with more than 1 billion users each. And that includes the likes of Search, YouTube, Gmail, Maps, Chrome. So that means it has the most data to eventually create the most personalized AI solutions for users. In recent times, it has rolled out more powerful Gemini models and launched AI Overview and AI Mode in Search. And the world just 6 months ago thought that Google is going to be disrupted by ChatGPT. That's now suddenly realizing that Google could actually become the AI leader. Right? Its most recent, I think it was launched Nano Banana video generation tools and image generation launched in its Gemini app have gone viral, and Gemini, which is its large language model's market share of the global large language model traffic, have gone up from 6% a year ago to 13% now. And the opportunity in AI for Google is really to build the digital assistant for 1 billion users. This is going to be an assistant that can answer your questions, give you advice, help you book and plan things. The assistant that will supplement your needs, both personally and professionally. That's truly the biggest prize. And Google charges around $30 a month for a Gemini Pro subscription today. And only power users pay. But via AI mode in search, Google is the only one with an opportunity to educate the mass users, the mass market users every day on the AI assistant's value and gradually convert the free users to paid subscription. And this is something similar to what we have seen with Spotify and Netflix, who over the last decade have both built 100 million subscriber bases over the many years. So this truly is a new growth vector for someone like Google, above its existing business lines. And furthermore, the chip side of things, Nvidia, for example, is valued at $4 trillion selling GPUs. Google has an equivalent chip they use in-house called the TPU. And they've just started seeing more companies adopt TPU through the Google Cloud. And again, the market is not fully appreciating the share gain in the chip space for Google. So at 25 times P, which is what you're paying for Google today, you essentially get the largest digital advertiser via search and YouTube. You get potentially the largest AI assistant business. You get a structural share gaining TPU chips business. And in Waymo, potentially you get the leading autonomous driving business globally. So all of this looks like a good deal to us, and quite a bit different from the 30 to 50 times revenue multiple that the market is paying for many of the other AI type businesses.
JC, since you're talking about geographies, I think we'd be remiss if we didn't ask the question of how deglobalization and industrial policy, here I'm talking about reshoring, subsidies, trade fragmentation, how is that going to reshape geographic winners and losers going forward?
Sure, I think there are many big implications, but there's one that the market probably doesn't speak enough about, which is how protectionist policies is likely going to hurt the US over the long term. For example, Chinese EV companies didn't become leaders because China closed the market to competition. They only became the dominant players they are today because China let Tesla come in. They let the Germans come in, the Japanese come in, and then they learned and grew through the competition they have in the domestic market. By protecting the incumbents without allowing any of the competition to come in, the US auto companies are likely to lag in technology development and over time lose in the EV space on the global stage. And probably another one that's worth mentioning, it's the US banning China's access to the most advanced NVIDIA chips. So again, in the short term, you might slow their progress, but in the long run, US is forcing China to make self-sufficiency in semiconductor a necessity. And we all know necessity is the mother of all invention, or in this case, scarcity becomes the mother of all invention. And on our trips to China and interaction with the companies, developers who were once happy to use US software and semiconductors are now defaulting to domestic solutions. And US restriction is really forcing China to become less reliant on their leading edge technologies. And in time, China will develop competing global solutions, which we are already seeing today, I think, especially in the AI space.
Thanks, JC. Ishrath, I have a few questions that have come through from our listeners, from our audience members around AI. One of the questions, what about the potential of AI to unlock productivity and accelerate GDP growth through new frontiers and markets? I mean, that's certainly one of the narratives that's feeding into the prices today. Wouldn't investors risk missing out on this massive disruption by not having enough of a position in US big tech?
Well, most technology breakthroughs in history, including transformational ones, have always taken time to bear out and have always involved serious casualties along the way. The railway boom in the 1840s, for example, was accompanied by a massive investment bubble. It eventually turned out to be transformative for both passenger travel and freight, but by the time its benefits materialized, the majority of investors were wiped out. It was the same with when the automobile was invented, and a similar story with the telecom and dot-com booms of the 1990s. The pattern across all these episodes is remarkably consistent. A genuinely transformative technology emerges, capturing imaginations and attracting huge investments. Then the capital floods in, often financed by debt, and then overcapacity develops. Reality fails to match inflated expectations and the bubble bursts. But in the medium to long term, the AI bubble, like those in past transformative technologies, can be extremely productive. The railway mania of the 19th century left Britain with a rail network that powered industrialization for generations, even though lots of money was lost at the beginning. The internet bubble's fiber build-out eventually provided cheap bandwidth, enabling the modern internet economy, cloud computing, and things like streaming video, with companies like Facebook, Amazon, and Google emerging from the rubble. So similarly, the AI build-out will likely be hugely transformational over, say, the next 10 to 15 years, but could lead to serious losses for those paying today's prices to fund it.
Okay, Ishrath, another question though. There are some who are asking, what if we're not in 1999, we're actually in 1995? In other words, we're still early in that AI disruption curve, which means that there's still a lot more upside ahead. Your thoughts on that?
Well, this could be true. We are still only in year 3 since ChatGPT was released in late 2022. So, and this is also why we wouldn't ever be 0-1 on this. And we own businesses like Alphabet or TSMC that should emerge as relative winners regardless of what transpires. But there are many danger signs already. The resurgence of meme stocks, zero-dated options, and leveraged ETFs already mirror the late-stage froth we saw in 2021, which signaled the end of that bull run. The number of ETFs, for example, now exceeds the number of listed stocks, which again creates circular liquidity and greater leverage in the system. Then we already discussed valuations. Tech names already trade at 99 like multiples, unlike the more reasonable levels of the 95 to 98 period. Tech giants like Nvidia at a $5 trillion market cap is already at more than 50 times free cash flow, leaving little room for outsized growth from here. Big tech no longer offers the unique upside it once did, but trades at very lofty 30 to 50 times free cash flow multiples. And if you look beyond that into the most expensive big companies within the S&P, so those companies trading at more than 10 times price to sales, this proportion of the market has shot through the roof to more than 35% of the S&P 500 versus around 25% at the very peak of the dot-com boom. These are stocks like Palantir, now a $450 billion company trading at more than 300 times earnings, or ServiceNow, a $200 billion business trading at 60 times earnings. So the ultimate question for investors becomes, how much of your retirement would you really bet on this AI bubble continuing?
Great. Thanks, JC and Ishrath. I think we'll leave the global space for now. Thank you very much for your input. Nick, let's talk about local opportunities. How does this all translate into the opportunities we're finding within the South African equity universe?
Yeah, I think it's important. You hear things like Nvidia and Alphabet and you get really excited. So, I mean, they're less exciting names in South Africa, but that doesn't mean they're less exciting opportunities. I think one of the key points that Rashad made at the beginning of his presentation was just the huge move down in the yields in the overall bonds in South Africa. So the blue line is, or the dark blue line is the 10-year bond through time since January 2023. And as you can see, it peaked out over 12% and it headed all the way down below 9%. Remember, bond rates are the risk-free rate in any country. That is the opening point that you do a valuation for in any equity valuation. So generally, the red line, which we use the big four banks as a proxy for South Africa Incorporated, is a really good indicator of what kind of return you'll get out of shares. So an earnings yield, for people that don't know, is the inverse of a PE, which just means how much earnings do you get out of a share price. That number there that you see of around 12.5% is the number that you should achieve both in dividends and reinvested cash flow that a company in the top or one of the top four banks will earn. What you've seen through time is the red line generally tracks the blue line as the earnings yield of the equity markets is a good representation of what you'll get out, but you also get a 5 to 7% earnings growth out of some of these banks over the next 3 to 5 years. So what you can see is that gap opening up is a real opportunity for the equity investor. As BlackRock and PIMCO have all come into our bonds, we haven't yet seen that in the same way in our equities, especially the South African focused equities. So should that line of 12.5% earnings yield trend towards the 9%, we're looking at almost a 30% revaluation of some of our SA Incorporated shares. So that's the one point, is on the valuation, there's a good opportunity. The second point is that what I've done here is I've shown the top 10 SA Incorporated shares that we own in the Foord funds. So it's not just some assumption, these are the companies that we own in the underlying funds. Importantly, total returns of companies are generally driven by the dividend yield and the earnings growth of those two companies. So as you can see from this chart, it's a 3-year chart of what do you expect to achieve with earnings growth and dividends on a compounded per annum basis from those companies. Most of them that you're seeing, assuming valuation is unchanged, will achieve this in share price growth. So as you can see, for example, FirstRand will give you just over 15% in earnings and dividend. It will become in the form of 6% dividend yield and around 10% earnings growth, which will give you the 16% earnings and dividend growth. This is a base case assuming the rating doesn't change in the shares. Most of them is achieving over 15% in earnings and dividends over the next 3 years per annum. So that's a really good operation or way to invest in a slow growth environment. Remember, Rashad painted a picture of very slow growth in South Africa. So we're not reliant on the economy for these companies to grow. In fact, we've built in 1 to less than 1% in GDP growth in these earnings assumptions. Importantly, they're not on the risky side of the discretionary retailers. A lot of these companies that you see are hospitals, discretionary, selling bread, selling basic clothing, and not really on the risky side where if things really do go pear-shaped, people will pull up the handbrake. So this is just another perspective on valuation. The black line is the 5-year average PE of those companies. The red line is the 1-year forward PE, showing that there's still opportunity in a lot of these companies from a valuation point of view, especially some of the banks as some of the biggest re-rating opportunities in our market. And in fact, companies like Wilson Bailey trade on only a 5 times PE, notwithstanding that very fast earnings growth. So I think what we're saying is there are obviously going to be slow growth. There is going to be risk. We think that a lot of the pricing is in our bonds. It is yet to truly filter through into the South African incorporated shares. And there's an opportunity to buy and hold really good companies with good earnings growth and valuations that aren't extreme. And actually there's optionality on the upside. So what have we done about it? If you go back to January 24, before the election, we were obviously cautious. There was a lot going on. A lot could have happened during the election in 24. Richard spoke about the formation of the GNU, a bit more stability. But importantly, the valuation froth came out of the market in South African incorporated shares. And what we did was we substantially increased our weighting to over 60% in South African incorporated shares. That was funded by a reduction in our offshore weighting, as well as spending the 14% cash that we kept waiting while the election took place. We now have less than 1% cash in our SA equity fund as an indicator that we've used most of our cash on those investments that I spoke about a little bit earlier. So Ishrat and JC spoke about the NVIDIAs and the Googles of the world. You don't only have to buy those kind of companies to make money for your underlying investor. It's a surprising one that I'm going to pitch one of the 10 ideas on the top 10 as one of the best opportunities to continue to grow in the slow growth environment in South Africa. And who would have believed that the Blue Ribbon company, the Snowflake company, has compounded at over 50% per annum since its listing. Foord have held it in big size since that listing, so it hasn't only been a new holding. And the great thing about companies like this is they continue to grow and be exciting that we still hold it in substantial size. So what is it? It's around 90% baking and milling, which is basically, in summary, bread and flour, to simplify things. They do have some peripheral things that will probably keep it simple for now. So what happened? Why did this bread business do so well? So what did it do? It was hidden from view inside bread for a long period of time, where the competitors weren't really watching it. They didn't see the full visibility of what was happening. But the really strong management team spent a lot of money consolidating some of the bread factories, plus some sweet factories, with around 3 billion spent over that time period. They also spent around 7 billion refurbishing a lot of their bakeries to make them the newest bakeries. As you can see, that capex to sale is an indicator of how much they spent to renew their factories versus the Tiger brands that maybe took their eye off the ball for a very long time. We do think that Tigers have woken up to some of this, and I think that is something for another talk, that Tigers is definitely getting better. But while that happened, and Pioneer and Tigers took their eye off the ball, Premier took their market share from 23% to 28% since 2019, and that number would look even better if I pushed that chart out further. That is a huge number in the bread market, which is generally quite static. How did they do that? As I said, their product was probably better than their competitors and they had a cheaper entry price, but importantly, their logistics was even better than the route to market, and logistics was better than their competitors. And they were able to bypass the big retailers like Shoprite and Pick n Pay and Spar and sell 70% of their product to the spaza shops where there's a lot more pricing power. So what's happening going forward? I think importantly, the earnings margin is still going to go up. We have seen a big acceleration in the last few years as the recent factories have come online. We're expecting another 1.5% growth in EBITDA margin, which is a proxy for operating profit margin. As you can see, the 2 new bread factories are about to come online. Each of them comes with much better technology. You're able to produce bread double the rate at 2 times the amount of loaves per hour with 3 times less labor. And that comes at a better cost to the consumer, better efficiency to Premier, and everyone wins. That's the perfect example of a win-win for the consumer and the shareholder. Importantly, companies can spend money and it can look good on the face of it, but the return on invested capital, which is basically how efficient are you using that money, as an indicator for how well they spent the money. So as you can see on the other chart, the return on invested capital chart, the return on capital is trending over 20%, which is a very solid number for a company that spends so much capital. So importantly, the marginal return on capital, which is a very technical concept, is actually over 35, signaling a really good use of capital by the company. So what excites us about a good management team? A good management team is never static. They're always thinking of ideas to grow the business. They're always thinking of ideas to make the business better than it was. So what has happened more recently? We've seen an announcement that Premier is effectively buying Rhodes Food, we're issuing equity for it, but they're buying a really good bunch of brands, which is important. It will diversify away from the bread, but they are buying into really interesting areas, which I'll go into a little bit more detail. Pies, Rhodes are quite dominant, canned fruit, jams, long life fruit juice, a whole bunch of really interesting #1 brands that they can do a lot more with. Importantly, inside Premier, there's a small Woolies private label business. Rhodes also has a Woolies private label business. Putting them together will have immediate efficiency gains. So what are we saying? What does this all mean in numbers? I think the first 2 years is all going to be around cost synergies. Interestingly, cost synergies in most mergers means people. We don't believe there'll be any people that will be made redundant to achieve these cost synergies. These are simply synergies of putting 2 businesses together and gaining a lot more cost savings, like I said in the Woolies Food example. So that we expect them to save between 70 and 200 million over the next few years, just purely on costs, which means that you'll have a 12% uplift in the near term just on earnings from costs. In the medium term, importantly, we think that there are much more opportunities on revenue synergies. Revenue synergies are priced between 90 and 350 million. Those are examples where you can take fruit juice, which Rhodes Food don't really sell at the spaza shops, put it on the same truck and do a good job of selling fruit juice to the spaza shop. So those sorts of revenue synergies are just quite easy wins that we think will add additional excitement in Premier. So as you can see from the other chart, the earnings growth, which is the red bar, we're expecting 15% compound earnings growth out of Premier from 25 to 2029. That's a per annum growth rate, which is still a very good number. But the Rhodes merger or acquisition of Rhodes, on a conservative basis, will move that up to 19%. On a effectively base case scenario or a neutral kind of assumption of those, the midpoint of those assumptions that are put on the chart, it will be 21% growth. And we think that there really is a chance that this business compounds at 23% per annum in earnings growth for the next 5 years. To 2027, as it says there, because notwithstanding the big share price move, because it's been a big upgrade in earnings, we think that it will be only an 11.6 PE out to 2027. So I think that's very important. I think I showed you that one of the ways to protect yourself is via equities that have good management, that are able to grow their earnings, but importantly are allocating capital well to continue that growth trajectory, because eventually, if you don't look after the business, you will slow. I think Premier is a perfect example that you don't need a very fast-growing South Africa to make good money for your investor in South Africa.
Thanks, Nick. I think it's time for a little bit of audience participation. We're coming to the end of our session. So I'm going to ask you what you think should be in the mix for 2026. So we've got 4 options for you. The first is that you don't buy Eshrith's argument. So AI productivity gains continue to support US growth, and the US stock market continues to soldier on as a result of that. The second option is more in line with cockroaches crawling out of the system, that cracks are starting to show, and that investors will need to look beyond the US for meaningful returns going forward. They're not going to come from the same place they came from historically. Third is a bit of an extreme view for those gold bugs out there. In a world of inflated promises, gold is the only asset you can count on to hold its value. And then last, South Africa Incorporated surprises on the upside, even with a 14-man team. So please give us your opinions. While everybody's answering the poll, Nick, I wanted to ask you to maybe put that all into context. So within the context of a multi-asset portfolio, you've got to make decisions as a portfolio manager between global, local, across the asset classes. Let's, for instance, take the Foord Balance Fund as a proxy. How are we positioned going into 2026 from that perspective?
Yeah, I think it's an important one. I think from the biggest part of the balance fund, which is equities, I think we, as Rashad said at the beginning, I think we're building the portfolios with the thought process that probably inflation is going to surprise people on the upside. It might not be a huge amount, but I do think that that is the base that we're building the overall portfolios on. What does that mean? I think we want to be quite equity-centric. Equity-centric is both locally. I spelled out the 10 opportunities in South Africa, and there are more than that. So we don't want to lose our wheelhouse. There's a lot of good opportunities in South Africa to hold a lot of equities in the balance fund, but also globally. JC and Ishrith painted a very interesting picture that you don't have to be in the Mag 7. It's a very bifurcated market. There's expensive companies, there's cheap companies, and we have the ability to buy good valued companies like a Fever Tree with growth trajectory that's not reliant on the environment, just like a Premier. We have the ability to buy a company like SSE, which is a utility company out of the UK, which effectively contracts with the UK government at an inflation-protected rate. That was up 20% in the last 10 days. We don't have to own NVIDIA to generate good returns. So I think equity-centric, good quality companies, you don't have to own the market, and I think that's a good component to own in the balance fund, and we're almost at maximum equity in the balance fund at the moment. And probably I'll hand over to Rashad, and he can talk about the other components of the balance fund.
Yeah, so I mean, in line with that inflationary theme, we do have a preference for real assets. So we have seen nominal bonds have a phenomenal rally in South Africa, and we think a lot of the good news is priced in terms of a lower inflation environment, in terms of the fiscal position improving, in terms of a positive political environment. On the credit side, spreads are extremely narrow across the board, not only emerging markets. There's not a lot of value in there. So on the fixed income side, where we're seeing value is in inflation-linked bonds, where real yields are 4.5% to 5%. So that means you're getting 4.5% to 5%, plus whatever inflation delivers. So your total return, I think, is going to be attractive in many environments because of the very low inflation which is being priced in. So that's definitely our preference. And if you look at the multi-asset funds, they've definitely tilted far more. The balance between nominal bonds and inflation-linked bonds has moved far in favor of inflation-linked bonds over the last year. And then on the property side, we're looking for companies which have a good yield, but also quality companies where we can see potential rental and therefore earnings growth. And Spear is a good example of that. It's a holding across our multi-asset funds, and there it's a Western Cape-focused company which are doing good developments, and they are getting underlying rental growth. It's very dangerous to buy property on a yield basis. People have gotten burned by that before. So good fundamentals with a good yield is where we're finding attractive opportunities.
Right, well, let's look at the poll results. So very, very interesting. Let me share the results with everyone now. So 15%, I'm afraid, did not buy Eshrith's argument that AI is perhaps late in its cycle and will have an impact on valuations at some point. They still believe that AI is the place to be. It looks like the vast majority, though, feel that you should be looking outside of the US. Certainly the old past performance is no indication of future returns. So look elsewhere elsewhere, diversify your portfolios. That's certainly in line with our thinking. And I love the fact that we have almost a third of the 300 people who've participated in the poll saying that South Africa Incorporated is going to surprise on the upside. So Nick, I think you made some convincing arguments there, or perhaps they've been a bit inspired by the Springboks of late. But either way, and of course, very few people thinking that gold is going to continue with its luster after such a spectacular run. So we've actually come a bit over our time. I'm going to do a little bit of a wrap up. For those of you who are short of time, please feel free to sign off. But I do like to do a little summary for those of you who like to just be reminded of what our views are from today. So those of you who are signing off, we are doing a little bit of a survey. They're just 3 questions. Please fill them in for us. We'd love your input. We want to make these sessions as productive as possible for you. So let me summarize our views from today. Firstly, Rashad outlined that we have views on how the dollar and gold may move forward, and certain views with regards to fixed income, our preference for inflation-linked bonds, our concerns about credit spreads. He described South Africa as having entered this year in a macro sweet spot, supported by strong gold price, lower oil prices, which means lower inflation, a lower inflation target as a result, and improved sentiment on the back of that. But he also flagged some key challenges that we need to keep an eye on. So this includes implementing the new inflation target, stabilizing government debt, and maintaining the GNU coalition. He concluded with a 2026 outlook which features modest US rate cuts, a persistent global fiscal strain though, and a preference for inflation-linked bonds and South Africa-focused equities, or those focused outside certainly of the US. That was reiterated, of course, by JC, who showed that Foord is far more broadly diversified in the MSCI World Index. We have a roughly 3-way split between Asia, Europe, and the US in terms of where our bottom opportunities show themselves, in comparison to the MSCI World Index, which is weighted 2/3 towards the US at this point. He highlighted the valuation dispersions across the regions, most significantly noting the elevated multiples in the US in comparison to the likes of China and Europe. On the sector front, Eshrath raised some key concerns about the sustainability of US big tech's performance. He talked to slowing advertising growth, rising competition in cloud computing, circular deals as a warning sign, and of course very high prices for those stocks being a headwind to future returns from the sector. And he presented the case for overlooked sectors such as healthcare and consumer staples, which offer more reasonable valuations and often much more stable earnings prospects. Turning to South Africa, Nick highlighted that while improved sentiment has made its way into the bond market, this hasn't been the case yet for SA Inc. type equities. So he explained how this translates into some exceptional opportunities, particularly amongst our high quality, more resilient key SA Inc. type companies, and he gave you 10 examples of that. And he explained how they can generate good returns just through their dividends and earnings growth, but if they do re-rate on top of that to more normal levels, that will actually provide even more upside. And of course, he highlighted the importance of the quality of management and the growth dynamics not being dependent on the broader economic growth. And he showed how we've significantly increased our holdings in SA Inc. type companies, which hopefully demonstrates to you that we are indeed finding good opportunities out there, despite South Africa being one man down on the economic front. So I hope that gives you a good idea of how we position going into 2026. As I mentioned, there will be a brief survey that pops up when you leave the session. So please do take the time to answer. There are only 3 questions. We'd really appreciate your input. Thank you to our colleagues in Singapore, JC and Eshrath, to Nick and Rashad here with me in Cape Town, and thank you to everyone who's joined us online today. I hope you all have a very restful holiday season, and to those who invest with us, thank you for your trust. We look forward to seeing you all back here next year. Take care, everyone, and thank you for joining us.